Trust Company. We're the leading self-directed IRA provider. We have, in addition to all of the many retirement accounts that we offer, lots of other investment vehicles that you can use for some very specific purposes, including health savings accounts, which we'll be talking about today, as well as education savings accounts. These accounts are great because you can utilize them for all types of investing, real estate investing, note investing, private companies, just to name a few of the many things that you can choose. However, for specifically health savings accounts that we'll be talking about today, it's great because you start generating investment profits that you can immediately start withdrawing tax-free to pay for all types of health expenses, as well as Coverdell accounts where you can pay for educational expenses for your children. So I'll go ahead and share my screen and we'll dive in. Let's see. 1 second here. Sorry, guys. Technical issues. Okay. Perfect. Not sure why this isn't working. We'll just go ahead and roll with it like this. So as I said, guys, today's presentation is all about health savings accounts. We like to call this one the triple threat of tax advantages. So the reason that we like to call it this is because there are so many benefits to the health savings account. In addition to the fact that you can possibly get some reduction on your taxes as you make deposits into the account, you also have the benefit of all of your investment profits growing completely tax deferred, and immediately being able to withdraw your funds tax-free. So as you can see, you absolutely get 3 different types of tax advantages for the health savings account. We love to talk about this account at Quest. It has very specific use, which is to pay for all of your medical expenses for not only yourself, but also for your family. But also just because in general, health expenses are something that are so important. And really, this account is very underutilized. Some of the recent, findings that we have here at Quest, as well as some of the experts in the industry, is that on average, Americans, in order to be able, once they retire at approximately the age of 65, in order for them and their spouse to be able to pay for health expenses throughout their retirement years, they really need just shy of about $300,000. Really, the number is about approximately $295K, which may sound like a very, very high number, but just keep in mind that this is truly just the average of what Americans will need. Obviously, there are medical expenses that may come up that are unforeseen, and as healthcare expenses may continue to rise, that number may significantly even be higher for you. So the health savings account is really a great account that you can be preparing for the future. Like I said, not only for yourself, but also for your spouse, for your children, to be able to pay. I did want to mention that along with me today, I have one of our IRA specialists in training, Evan Reeves. He is moderating today's class. So for those of you that are tuning in from Facebook, or if you're tuning in from Zoom, you'll be able to chat with him in the question or Q&A feature on there. Or if I reference any type of classes that you may want to watch after this presentation, you can also just get a link that he'll provide in that comment section. So our disclaimer is that Quest does not provide any tax, legal, investment advice. We don't endorse any products or services of any type. All the information and materials are really just strictly for educational purposes only. Of course, all parties are encouraged to consult with your attorneys, financial advisors, anyone on your team before entering into any type of transaction. So really what this is breaking down to saying, kind of what this legal language is saying, is basically an explanation of our role at Quest. We don't provide any tax, legal, investment advice. We don't sell any types of investments or connect you. We don't say, hey, we've got this fund, you can get X type of return. That's really the benefit of a self-directed IRA, is that you're in control. You're the one that's choosing all of the investments, You're really the one that's in the seat driving this and choosing all the investments for your account. So certainly along with that comes being familiar with doing due diligence. If you're not familiar, then also consulting with people like attorneys, your financial advisors, CPAs, before entering into any type of transactions. So this is from a Gallup poll that was recently done. And I think it's really fitting. I always like to start off when we talk about health savings accounts with this one here. It talks about some of the top financial concerns that Americans have. And as you can see, some of the top two relate to what we're going to be talking about today, being able to pay for all types of healthcare, medical expenses, not only for today, but also having the adequate amount of money saved up for the future so that you're able to comfortably retire and know that you'll be able to be taken care of through the rest of your days. But as you can see, some of the ones that we won't necessarily talk about today, but are things that Quest and the vehicles that we offer here where you can choose your own investments would be helpful. You can see some of the other top ones, aside from being able to pay medical expenses or just normal types of healthcare, are things like retirement, being able to pay off debts, being able to maintain a certain standard of living, or paying for children's educational expenses. Today we'll specifically talk all about health savings accounts and how you can use these types of accounts to pay for your health expenses for today and in the future. But if you're new to us at Quest and this is your first time tuning in, really our bread and butter here, one of the most popular types of accounts that we offer are our retirement accounts, our traditional IRAs, our Roth IRAs, SEP IRAs, and things of that sort as well. So in addition to being able to pay for all types of health expenses, there's also lots of other investment vehicles that we offer where we can help you to prepare for the future, for retirement, for educational expenses, and things of that sort as well. But as you can see, health expenses, health costs, and the rising cost of healthcare are really at the forefront of what Americans are concerned about right now. I saw a article that I read probably close to about a year and a half ago, 2 years now, but it was talking about all of Americans' concerns. What are the reasons why Americans, unfortunately go into, bankruptcy or really have serious financial issues that happen for them. And it kind of talked about it over the course of the last about 10 years and how there's been really a significant shift. 10 years ago, some of the top reasons why Americans would go bankrupt would be things like foreclosure or extreme debt, credit card debt, other types of debts that they may have. But what was interesting is that the shift that happened over the course of about, like I said, the last 10 years, the number one reason now, today, why Americans go bankrupt and really lose everything is not because of foreclosure or credit card debt, though for some people that, of course, can contribute to it, but it's actually because of medical expenses. Them or one of their immediate family members having an unexpected medical emergency and it being very costly and something that they weren't sufficiently planning for. And so the one thing that I think that, like I said, is so undervalued is being able to not only choose all of your investments, but being able to choose investments that that you understand, that can be lucrative for you, but doing them in a vehicle where you can begin immediately taking those tax-free distributions out. And that's exactly how the health savings account works and why I think it's really growing in such popularity that we're seeing. So some of the things that we'll cover today as we go through is first off, our self-directed IRA basics in about 10 to 15 minutes. We're going to do a really high level, quick overview for those of you that may be tuning in for the very first time. If you are tuning in for the first time, I highly, highly encourage you to watch our foundational class. We call it our self-directed IRAs 101 kind of class, but it really goes over all of the need to know information about self-directed IRAs that you'd want to know before you got started, or if you're a brand new client with us. It goes over very in detail all of the different types of accounts that are offered, goes over the tax benefits of them, some of the prohibited transactions, so kind of the things that you want to be aware of once you start, actually picking your investments. What are some of the things that you'd want to stay away from? And then it's got some great case studies as well. We're going to just quickly do just a couple of slides as a preview of what to expect in that class. But if you are new and you'd like to watch that, check it out. Evan, who's moderating along with me today, will drop that in the comment section on Facebook, as well as in the chat feature here on Zoom. You can also access all of the classes that we have at Quest, because we are known for our free education that we offer here, by going to questtrust.com and accessing our recorded self-directed IRA classes. There's probably about 20 different classes on there, some about self-directed IRAs or health savings accounts, but some that just focus on general topics like how to do investments with less than $10,000, or different types of investments that can be done inside of these accounts. So highly recommend you check those out if you're new with us. We're going to talk specifically about self-directed HSAs, all about the many benefits and how specifically you can utilize these types of accounts. And then when we're done, where to find more free information and education afterward. So what exactly is a self-directed IRA? We get this question all the time. It's kind of funny, we'll have clients and they're brand new with us, and they'll get to the stage where they're filling out their application and they're ready to set up their account. And sometimes they'll pause and say, well, wait a minute, I might have the wrong application here. I'm filling it out and it says just traditional IRA, or it says just health savings account, right? I want the self-directed one. Is there a different type of application or something like that? We always kind of laugh because it really just goes to show you what a huge misconception there is around these types of investment vehicles. Really, we like to say that self-directed is actually just a marketing term, right? It's just trying to get across the point and connotate that, you're the one that's in control. You're choosing your own investments. But there's really no specific type of account called a self-directed IRA. We like to say an IRA is an IRA is an IRA, right? If I have a Roth IRA at Fidelity and I have a Roth IRA at Quest, those are exactly the same types of accounts. Or if I have an HSA at, Bank of America, and I have an HSA at Quest, all of these accounts are exactly the same, no matter which company that you're with. Really, I think where the misconception comes into play is that there is no difference in the accounts. The difference is really in what the two companies are going to allow you to invest into with those accounts. So over at a Fidelity or Charles Schwab or Edward Jones, or insert whatever company that you may currently be with, you're going to have the same style of account as what you'd have here at Quest, except that you're exclusively going to be able to invest in what's considered a publicly traded investment. So, these are things that you're probably already familiar with, that you might already be doing, right? Like mutual funds, stock investments, all types of publicly traded deals. Whereas at Quest, again, with the exact same type of account, we're giving you the ability to, one, choose all of your own investments, but two, the investments that you choose over here at Quest are going to be all types of private assets. So I named a few at the start, all types of real estate deals, residential properties, all the way up to, maybe commercial deals, multifamily investments, private companies, all types of note investments, secured notes, convertible notes, all sorts of different investments. But the point being is that all of the rules that you're already familiar with your IRA that you already have, or your health savings account that you may already have, all of that is exactly the same at Quest, except that you're going to be the one choosing all of your own investments and still getting all of those great tax benefits while you're at it. Real quick, what are the benefits? I'm sure many of you are already familiar with these. The first one being diversification. If you talk to most Americans, they would say that, I probably am diversified. Maybe I've met with a financial planner and I've got a variety of different things in my portfolio. I've got some high risk types of stock investments, but maybe high return. I've got some kind of blue chip investments. I've got some mutual funds. I've got some fixed rate type of investments where I'm getting a fixed rate of return over a period, like a CD or an annuity, right? Maybe something like bonds, right? All different types of investments. But what's the problem with all of those? Well, the problem is that while it's great that you've got a variety of different investments that were outlined, unfortunately, all of those are publicly traded investments. And so in our opinion at Quest, one of the ways to have true diversification is to absolutely have publicly traded investments. But in addition to that, in your portfolio, to also have perhaps some more tangible types of investments, things like real estate that really are going to allow you to have your foot in both sides. You have the publicly traded and you have the private types of investments as well. Really the whole big benefit of using self-directed IRAs, using self-directed HSAs is going to be those great tax benefits that you get. We're going to talk about this extensively as we go through. But as I, kind of teased at the beginning, the HSA, we like to call, really having a triple threat. It has 3 different types of tax benefits with this types of account. And truthfully, all of the different vehicles that we offer here at Quest have so many different tax savings as well. Lastly is investing in what you know best. As I said at the beginning, at Quest, legally, we're completely neutral. We never sell you any investments, right? We never suggest a fund or a specific type of investment, nothing like that, right? We're completely neutral. So our job is to provide you an account, right? And then you choose the investment and we make it possible for that account. We are going to help you to do all the processing, right? We're going to help you to do the upkeep on the investment, except that you're going to be the one that's choosing the investment, right? It's a self-directed IRA. So you're the one that's going to choose something that you're knowledgeable about, something that you know and understand in order to benefit your, in this case, health savings account. Now at Quest, we have 7 different accounts that we offer here. As I said, that self-directed IRA 101 class goes very in detail about all of these, but just to give you a brief synopsis of each of these, we have our personal plans, which are our traditional and Roth IRAs. Traditional IRAs are great for those of you that maybe have a 401k, a 403b, you were a teacher, worked for the government, you have a pension, any type of work-sponsored type of plan that you may have. You're able to move those into traditional IRAs without any type of tax consequences and begin immediately choosing your own investments for these types of accounts. And your money grows in the exact same manner as what you're already familiar with, such as in your 401k, in that it's growing tax deferred. Now, conversely, the Roth IRA is one of the most popular accounts that we get questions about because all of your investment profits grow completely tax-free. And it can also be great for those of you that are on the younger side. Maybe this is your first retirement account, because any deposits that you make into the account, you're able to access and withdraw them for any reason, tax and penalty free, whenever you would need them. So in that sense, it's great because you can save, you can grow your money tax free, but should you need it, you have the ability and the flexibility to be able to access it. Our employer plans are SEP IRA, Simple IRA, and Solo 401k. These are great for those of you that are self-employed. You can make very, very large contributions, upwards of 60,000 even, into some of these plans, and possibly get some tax deductions as well. So for those of you that perhaps have self-employment income, maybe you have your own small business, anything like that, these are a really great option to consider. And also your funds in the same manner as the traditional or 401k. Again, these are going to be growing tax deferred. And then lastly, our special plans. So the Coverdell Education Savings Account and Health Savings Account. The Coverdell ESA is a great account where you can pay for all types of educational expenses completely tax-free for your children. So basically, you can partner it alongside your own account. You can put all the money together. And when it comes time to paying for your kids' educational expenses, that investment profit that you've made can be immediately withdrawn completely tax-free and go towards paying all types of education expenses. It can pay for things like tuition, books, school supplies, or even larger scale things like equipment. Maybe your kids need a computer, maybe they need some type of equipment, maybe they're at home learning this year with distance learning and need headphones or a mouse or things like that that they may not have otherwise had. Imagine that you could start paying for those sorts of things completely tax-free. And lastly, our health savings account, which is what we're here to talk about today. It's an account that you can use to pay for all of your medical expenses for you, your spouse, for your children, completely tax-free. And remember, guys, all of those plans that we talked about can be self-directed. So with all of those types of accounts, you can choose your own investments and begin taking control of your own retirement and making that tax deferred or completely possibly tax-free investment profit to be used for all of those different uses. So some of your money can be utilized for retirement, some of your money could be going towards kids' education or your family's health expenses. So you can see how there we have a lot of clients that maybe, they're introduced initially to the self-directed IRA, they're introduced to retirement accounts, but then as they start going further and learning more about these, realizing that, maybe it makes sense for their spouse or their children to also have accounts. And this can be a great idea because what this allows you to do is actually partner all of these together. So what you're seeing here is the individual vesting versus the partnered vesting. So remember, whenever you're using one of these accounts to invest with, it's going to be the account itself that's moving forward and purchasing the investment. So if you think about it in terms of something that maybe you're more familiar with, maybe stock investing, it's your IRA that is, purchasing the stock investment and then money returns back to it. It has a share in this publicly traded company. It's the exact same thing when we're talking about something like real estate or a private company. It's your IRA that actually has a stake or is taking ownership of this asset. And so when we title these investments, it's going to be in the name of the IRA, which is what you're seeing here, Quest Trust Company for the benefit of first and last name and then IRA account number. Now, the second one here is the partnered vesting. This would be in the event that you partnered multiple accounts together. So as I mentioned on the last slide, perhaps you already have a retirement account and you're thinking that you may also benefit from a health savings account. You can pull money from the health savings account and your retirement account and partner it together so that each account would have an ownership percentage in the deal. And as you begin generating profits off of your investment, you then have money that's coming back in those ownership percentages back. So perhaps you're allocating some of your investment profits back to your retirement account for the future. That's kind of more of a long-term play. And then some of your money allocating that back to the health savings account that you can immediately start using for your health expenses. And this can be done for any of the accounts that we offer. I'm just using the example of the health savings account because that's what we're here today to talk about. But you can also be doing this with multiple different retirement accounts, your kids' education savings accounts, all of them. So, for me personally, I've done an investment with my own IRA where I had 7 other types of accounts that were partnered in there. So I had some family members and some friends and, some were education savings accounts and some were health savings accounts and some were retirement accounts. And it allowed multiple people to be partnered into the deal, but also allocating funds back for all those specific uses as well. So this is a really, really great strategy that you can be using if you already have maybe multiple accounts. Now, like I said, the self-directed basics class goes all over the prohibited transactions, but it's very important to consider these types of rules before you move forward with doing any types of investments. Just to give you guys a high-level view, basically there are some restrictions that exist when you're using self-directed IRAs. You as the owner of the account, you're the fiduciary to the account. And it's your responsibility to make good investment decisions and choose investments because it's a self-directed IRA, and neither can your family. So you have to go out and find a new investment, right? Or as you're selling your investment property, sell that to someone that's not in your family, right? You can't live in your IRA owned property, right? Anything where you or your family members are personally benefiting off of the transaction is generally a no-no. Now, like I said, guys, this is just a very brief synopsis of a couple of the things that you can't do. Truthfully, there's so many incredible things that can be done in these types of accounts, but there are some restrictions to be aware of if you're a new investor and maybe you're not as familiar with self-directed IRAs. So if you have any questions or you'd like to go into it more in depth with us that this class doesn't cover, you can watch our self-directed basics class or feel free to give us a call. Our number is 855-FUN-IRAs, FUNIRAS. Like I said, we do free consultations with our IRA specialists. We have 15 certified IRA specialists on staff that are here to answer all of your questions. So as you start beginning to get in the process of looking for deals and considering investments that you'd want to do inside of your account, you can always give us a call and we'll kind of chat about it and figure out and make sure that that's something permissible for you to do. Now, as many of us know, healthcare costs are continuing to rise. You can see that it's definitely on the incline here in all of the different areas. So, cost in having some type of vehicle that can help Americans prepare for that future and continue to, be able to sustain themselves, as today healthcare expenses are rising as well, right? And so, as you see, these are just some quick stats. It was from the Federal Reserve. They did a study about 3 years ago now, and it basically talked exactly like what we were discussing at the beginning of the presentation, that, Americans are struggling and they're not saving sufficient enough funds for the health expenses that are going to be coming their way in the future. Of the individuals that were surveyed for this study that they did, 44% of Americans said that they would not be able to pay an unexpected medical expense that exceeded $400. In the grand scheme of things, a medical expense of $400 is really minimal compared to some of the expenses that could come up in the future, right? And we've seen that happen to people. So having a vehicle like a health savings account can really be helpful in preparing, being able to pay for those everyday expenses that you may have now, but also knowing that you have that kind of security net, that nest egg for the future for yourself and your family. So let's talk about the health savings account and exactly what it is. So basically, the HSA is what we call a tax advantaged account. Like I said, there's 3 different major benefits that we'll talk about in a couple slides that exist with the health savings account. Now, the health savings account is designed to pay for medical expenses. It's not to pay for health insurance premiums. You will have health insurance, but it's designed to pay for all types of medical expenses that come up. And that's not only for yourself, but it can also be used for your spouse and for your dependents as well. It's been around for quite some time now, since 2003. And one of the unique things about the account that makes it so popular in comparison to some of the other vehicles that are out there, and we will talk about a comparison of those as we continue, but one of the things that makes it so popular is that funds continue to roll over and roll over into the following year. I know with some existing accounts that are out there, such as like flexible spending, those types of accounts are what we call use it or lose it. So any money that's in there at the end of the year that hasn't been used, it's gone, right? It doesn't continue on. It's removed from the account. With the HSA, it's not a use it or lose it plan. So any money that you didn't use continues to roll over into the next year and can still be utilized. So this is a great account because you're not penalized essentially for being healthy, right? If you have an FSA and you have a great year and you're really healthy and you don't use those expenses, unfortunately, that money goes away. Whereas with the HSA, that money continues on for future years that you may need it. Now, like I said, we kind of call this one the triple benefit, which is great that it has all these different uses that you can have for this account. So the first one is that contributions are tax deductible. So if you owe a little bit of money on your taxes this upcoming year, one of the great strategies that we talk about here at Quest is that you can simply make a deposit into a health savings account, and in return for making this contribution into this HSA, in return for that, it's basically incentivizing you because you're going to get less that you owe on your taxes. So rather than paying, directly Uncle Sam, why not put a little bit of money into a health savings account that you can use for the future? This is a really great option, something that you can talk about with your tax advisor, with your CPA, to see if this could be a good option for you should you owe taxes. Also, your investment earnings are growing what's called tax deferred. So what this means is that as you begin doing your investments, let's say you invest in a private company, or let's say you buy a rental property, right? Whatever it is that you're doing, whether you have dividends coming back or you have some cash flow coming back, whatever the investment is that you're doing, as your money starts coming back into the account, you're paying absolutely no taxes on that investment profit. You finish up and all the money goes back into the account. So if you flip a property and you make 50,000 in profit, the full 50,000 would go back into your health savings account and you're not taxed on that. Or if you're invested in a private company and you have dividends coming back periodically, all of your dividends are coming back into this HSA and you're not being taxed on them, right? So very, very good as you begin to do your deals that you're not incurring any type of tax on them. But the best part of the HSA is that your distributions for what's considered a qualified medical expense are completely tax-free. So as you begin having your expenses that are coming up, maybe you need to buy some medication or you have to go to the doctor and you need to pay for these sorts of things, you can begin withdrawing completely tax-free distributions to pay for all of these medical expenses. And again, it's not only for you, but it's also something that can be utilized by your family members as well. So in order to have an HSA, there are some specific qualifications in order to qualify to be able to contribute to this type of plan. So the first one is having a high deductible health plan. So you must have a high deductible health plan, an HDHP, in order to qualify for this type of plan. Now, if you're not sure if your plan is considered a high deductible, you can certainly call your health insurance provider and discuss with them and see if that's a high deductible health plan that's HSA compatible for you to have that. For those of you that maybe are savvy online, maybe you have a portal that you can log in online and access a statement. Oftentimes on your statement, in the top left or the top right, it might have your name and your account number and some information like that. Oftentimes on your statement, it may also even say HDHP. So a couple different ways if you're not sure if you have a high deductible health plan. But that is one of the requirements in order to have an HSA. Now, perhaps you're with your current company now and you do have an HDHP, but in the future, should something happen, would you be able to use the HSA? And the answer is yes, absolutely. If you set it up now and you do have a high deductible health plan and anything changes in the future, maybe you go to a new job or maybe you change your health insurance plan and you no longer have a high deductible plan, you can still absolutely utilize the HSA and take those distributions for your health expenses, and you can still invest and grow the account. The only thing you're not going to be able to do is make contributions. So just keep that in mind for in the future if something changed. But if for right now you do have a high deductible health plan, then absolutely you can set up an HSA and begin making contributions into the account. The other two requirements in order to have an HSA is that you cannot be enrolled in Medicare. If you have an HSA prior to being enrolled in Medicare, again, same thing holds true as with the high deductible health plan. You can still utilize the account for your expenses. You can still grow the account and do investments. You're just not going to be able to make additional contributions into the plan. And then lastly is you cannot be claimed as a dependent on someone else's tax return. You can absolutely have a dependent and you can pay for your dependent's health expenses. But if you are a dependent on someone else's tax return, then you cannot have your own HSA. Now, the contribution limits are fairly sizable. And, for the past several years, they've continued to go up. For 2020, the maximum contribution for a single is $3,550. And the max for a family is $7,100. Now, what's the difference between these? Okay. So you're going to qualify for the single contribution if your health insurance is only covering you. So maybe at your job, you only cover yourself, and then perhaps your spouse is covered at their own company, or perhaps your children are covered on a different health insurance plan, right? Then you're only going to qualify for the single contribution. Versus for the family, that would be if perhaps it was you and your spouse on the same health insurance, or if it was perhaps you and your children or the whole family, right? Then you're going to qualify for a higher contribution limit based on the family type of coverage that exists for your health insurance. And for those of you that are above the age of 55, you also get an additional $1,000 that you're able to contribute into the plan. So if you qualify for a family plan, if you're covering maybe you and your spouse or you and your spouse and your children on the plan and you're over 55, you can put in a max for 2020 of 8,100 into the account. So a really nice chunk that you can contribute in there, and one, get those tax benefits, but two, it really gives you a lot that you can work with to be able to invest and grow to have more money and begin paying for those types of expenses. For 2021, they just released the contribution maximums and they did go up. So for 2021, went up just $50 to 3,600 for the single, and for the family, it went up $100 to 7,200, with the catch up of $1,000 over 55 remaining the same. Now, keep in mind that the open and funding deadline for this is April 15th of the following year. So for the 2020 tax year, you actually have until April of 2021 until for the deadline to make your contribution. So keep that in mind. For those of you that are considering this type of plan, maybe want to set one up and get your contributions in. We always encourage you to get them in, before the end of the year, before things get really, really hectic. But you do have all the way up until the tax filing deadline, April 15th, in order to do that. Now, what are some of the things that you can pay for? I kind of gave you a few quick things, right? I talked about that you could pay for doctor's visits or medications, but truthfully, it's very extensive what you can pay for. Doctor's visits, as I said, all types of medications. This can be prescription medications that are being prescribed by your physician, or it can just be kind of the everyday things too, right? Your Tylenol or your Advil or Excedrin, right? Those sorts of things as well. It can pay for all types of vision and dental care. So for those of you that wear glasses, or perhaps you need contacts, right? Or surgery on your eye, all types of vision care, dental care, fertility, chiropractor, ambulance expenses, if you're hospitalized, therapy, x-rays, and so many more things that can be found in IRS publication 502. It actually has them in alphabetical order. It's got all of the things that you can pay for, and then it gives you a listing of all the things that you cannot pay for. If you want to access IRS publication 502, you can message Evan, who's moderating today, and he can provide that to you. Or if you're able to just simply Google search, you can type in IRS publication 502 and it'll pop right up as a PDF, and you'll be able to access that and check it out for yourself. Now, there are some expenses that are not allowable for these types of plans. And while it is very, very broad in terms of what is covered, there's some very specific things that are just not allowed for these accounts, including health insurance premiums, right? It's not to pay for health insurance premiums. You have your high deductible health plan. Your HSA is really essentially to pay for your expenses for your medical needs. Some of the other things that you can't pay for would be unnecessary cosmetic surgery. So just to give you a quick example of this, unnecessary cosmetic surgery would be, should you decide that one day you wanted to get a nose job, right? If I woke up one day and was just not feeling good about myself and said, I think I'm going to get a nose job, I could not pay for that from my HSA. Versus if you had breast cancer and you wanted to get breast implants after that, right? This would be something that you could pay for. So it further defines that in IRS publication 502. So I always like to refer people there because it's got a really good synopsis of all the things that you can and cannot do. Other things you can't pay for, funeral expenses, nutritional supplements, teeth whitening, vet fees, and a few other things. Again, you can check out in IRS publication 502. But truthfully, there's so many things that you can pay for. For me personally, I've had an HSA for years. It works very, very well for me. And I'm actually going to show you just a really quick story in just a couple of slides about how I utilized my account, and it was really helpful for me. Now, in order to use your HSA, you do need to keep some good records. For those of you that are interested in setting up a Quest account, you do not have to submit, receipts back to us at Quest. You would complete our distribution form, and within 24 to 48 hours, we would send you the funds. But you do need to keep sufficient records, keep your receipts, keep a little file and a log of all the things that you were taking distributions for, just in the event that you were ever audited, that you'd be able to say, hey, I bought medications, I didn't go to Best Buy and buy a TV with my HSA, right? You just want to have sufficient records to show what you were paying for tax-free. Now, this shows you just a really quick comparison of the different types of accounts that we often hear that are compared to HSAs, flexible spending accounts, HRAs, which are health reimbursement, and then, of course, the HSA, which is our account. With the FSA and HRA, they're both employer-owned. So what this means is that these accounts are owned by the employer, and should you generally ever leave the company, it's not something like with the HSA that you can take along with you, where it's your account and you can transfer the money and continue having that. It is employer owned, and so generally those are going to be restricted, that those stay at the employer that you're currently with. Also, the contribution limits for the HSA, as you can see, are quite a bit higher. And for the HRA, it's really dependent on what your employer allows. Also, for your HSA, it's very broad in terms of what it covers versus some other plans. Your employer may have some specific approved expenses and some that are not, versus it's the IRS that has a very long outline of all the things that you can do in HSAs. So as you can see, there's a lot of difference here. Generally speaking, these other accounts are use it or lose it versus the HSA that continues on. The funds are not lost if you don't use them in that year. And also, last but not least, specifically when we're talking about with it being a self-directed IRA, SSAs and HRAs generally don't have investment options, right? And certainly not self-directed. Whereas with the HSA, you can not only choose all your own investments, and be able to make those tax-free profits for them. So for those of you that are familiar with us at Quest, this is our president, Nathan Long. You might be wondering why there's a picture of an airplane, how that could possibly fit into a story when we're talking about health savings accounts. But his story has a really great lesson that taught me one of the biggest perks about these health savings accounts. We often hear people say, oh, well, I'm not going to set up the plan. I'm really healthy, or my family's really healthy. I'm young. I don't need that type of plan. I'm not concerned about it. But one of the great things about HSAs is that you can reimburse yourself for past year's medical expenses as long as your HSA was set up. So I'm going to tell you Nathan's story, and then I'll kind of explain again what the benefit is. So Nathan, at the time, his wife had some very costly dental work that needed to be done. And, having been familiar with self-directed IRAs, this was, kind of pre-Quest, Nathan was familiar with HSAs and had already set up this type of plan. However, being a new HSA holder, of course, there was not very much money in the account. And when his wife had the dental procedure that came up, they did not have enough money to be able to reimburse themselves tax-free from the HSA. However, it was set up, there was a little bit of money in there, and he was actively investing it. What Nathan did is he paid out of pocket for his wife's dental procedure. However, remember, we always tell you, keep good logs, keep those receipts and that medical record. Well, the reason being is that fast forward about 5-6 years down the road, Nathan had invested and grown that HS himself for this very costly procedure. A few years down the road, he did. And by holding on to that receipt, he was able to then reimburse himself. So setting up an HSA is a great idea, even if you do not have health expenses right now, because you don't know what the future holds. And should something come up a couple years down the road, you're going to be kicking yourself like, man, I should have set that account up because I could grow it. I could make those tax-free profits and begin to reimburse myself. So now you're probably wondering, well, how does the airplane come into play? For those of you that don't know Nathan, he is a pilot, likes to fly airplanes in his spare time. This was his plane that he had. It was a Cessna kind of antique airplane. And so being an antique airplane, it needed a new engine in it. Well, on paper, always eating very healthy, exercising. My mom was very, very conscious about, what she fed us. Growing up, never had a cavity in my entire life until fast forward when I had moved out of my parents' house. I was out there on my own, had an HSA set up because I was familiar with these types of plans. And being a young person, wasn't really sure if I would be able to really utilize this plan for quite some time. Very healthy, don't really have a lot of health expenses that come up, but it ended up being such a safety net for me. So growing up as a kid, I always loved sweets, always loved candy, right? But like I said, growing up, my parents were very health conscious. We were the people that went to the dentist, every 6 months, like you're supposed to. So I never had a cavity in my life. When I was young, kind of had recently moved away from my parents after doing this, you're eating on your own, you're doing your own thing, splurging, eating all this candy and sweets and things like that. I remember I went to the dentist, and in one, time period of having not been there, when I went, they said that I had about 4 or 5 cavities at one time. So I kind of laughed and was like, well, all those years of sneaking candy on the side, it's finally caught up to me. And so for a young person, being able to pay for, those types of dental expenses that would come up, would be very, very costly. But for me, I didn't have to even consider where this medical expense would come from because I had my HSA set up. And just by doing 1 or 2 investments in that type of account and having some tax-free money in there, I was able to immediately be able to pay for all of those dental needs. It wasn't like I had to save and prepare for that. I was able to just immediately pay for that with tax-free money. So you can see that, even for someone that's young and healthy, there's absolutely those kind of everyday expenses that you can pay for completely tax-free. I also wear contacts and glasses in the evening when I'm getting in bed and, reading at night. All of those sorts of things can be paid for completely tax-free too. So kind of 2 different stories, but both real world experiences of times that the HSA was very, very helpful to us. A couple quick fun facts about the HSA. So remember that one time in your life, you're able to fund the HSA from your traditional IRA. As I said, you can make deposits into the HSA, or if you've got an existing HSA, you can transfer over funds. But one time in your life, you're able to actually fund the HSA via a transfer from a traditional IRA, right? So if you've already got a retirement account and you'd like to just move some money over, you can definitely do that to set up your HSA. And you can pay for prior year qualified expenses as long as you incurred the expenses once the HSA was already in place. And believe it or not, HSAs can pay for non-medical expenses, though generally speaking, this is not a common thing we see. But technically, if you needed the funds, you could certainly draw from them, though you will pay taxes and a 20% penalty. And one of the great benefits is that after the age of 65, you can always use your HSA for health expenses tax-free. But after the age of 65, your HSA really becomes similar to a traditional IRA in that you can start taking non-medical distributions out. You're still taxed, but you're not penalized the 10%. So just like a traditional IRA. Now, if you're wondering what happens to the HSA when you would pass away, it is a little bit different than IRAs. With IRAs, they pass on and you can create generational wealth as you pass on those accounts to your children or grandchildren or other family members. It doesn't really quite work like that with HSAs. With HSAs, if it's your spouse that's the beneficiary to the account, then the HSA becomes their own. They have their own HSA and the money essentially transfers into their own plan that they can utilize themselves. Whereas if you leave it to anyone other than your spouse, their options are very limited. It does not pass on to them. Essentially, the HSA has to be distributed to them, but there is no 20% penalty, which is nice. And one of the small perks on there is that the beneficiary can still use the HSA for up to a year after the account holder's passing in order to be able to pay for some of those residual type of expenses, medical expenses that may get billed later on throughout the year. Now, in relation to this year, with the CARES Act, with COVID-19. One of the great provisions that was in the CARES Act is that your high deductible health plan, your HSA, can actually be paying for COVID-19 related types of expenses, whether that be testing or if you, hopefully not, but should you contract this, it would also be able to pay for medical expenses associated with that as well. So nice perk there for those of you that may have to get a test coming up. If you have an HSA, you can be paying for that completely tax-free. Now, other useful IRS publications that you can check out are, like I said, IRS Publication 502. This one outlines all of the expenses that are includable for HSAs, but there's also another great one called IRS Publication 969, and it really goes over kind of the ins and outs and rules, tax benefits, ramifications, and some of the other need-to-know things about HSAs as well. So final thought for today, guys, is taking advantage of the flash sale that we have going on right now. We have a really good promotion. Generally speaking, we have not done this promotion in quite some time, but we're going to be doing a flash sale for health savings accounts. Normally, it's $100 to set up the account at Quest, but we are completely waiving all of the account setup fees for setting up an HSA. So very, very simple to do. You can complete the application online. And if in the future, for whatever reason, you decide, hey, I need a little bit more time, maybe I'm not quite ready for this, we have absolutely no account termination fee. So it's really a no strings attached offer. You can set up the HSA for free. There's no account minimum. You do not have to make a deposit. You can set it up for free, get a little bit more education, figure out how you want to utilize the account, and begin taking control of all of you and your family's health expenses to pay for them completely tax-free. In order to take advantage and set up the HSA, you can check out our website and complete the application there, or you can give us a call again at 855-FUN-IRAs, and we can walk you through all of the application. We can talk more in depth about your personal situation and HSAs, or even just generally about self-directed IRAs that might be a good fit for you or your spouse as well. So in closing, what can Quest do for you? Remember, we can help you to grow your wealth completely tax-free, not only for your health expenses, but also things like your family's education expenses or for your retirement, and provide lots of valued, ongoing, and free education to help you on course and teach you about the many, many opportunities that exist with self-directed IRA investing. Of course, access to networking opportunities. We know that all of our events have to be virtual for now, but that doesn't mean that the education and networking has stopped. We have lots of networking opportunities where you can network virtually with us twice a month with other investors throughout the United States, and even deal pitch on there. So check those out on our website, questtrust.com, under our events tab. And lastly, of course, what we're known for is our fast and friendly customer service and no expedited fees. Everything we do within 24 to 48 hours. Very, very quick. This is my contact information for those of you that may want to connect with me after the presentation. If you'd like a copy of the slides, if you'd like to connect with me directly and ask some questions or do a consultation, I'm always happy to do that with you guys. You can also, as I said, find us on our website or give us a call or find us on social media. We're really active on Facebook, Instagram, LinkedIn. We're always posting pictures and articles, updates with legislation that may relate or investment opportunities. So check us out there as well. And thank you guys so much for having me today. I hope this was helpful in teaching you how you can take control of not only your retirement, but also begin paying for all of your health expenses completely tax-free. So it's a great way to end this year and be able to start the new year in 2021, being able to pay for all those everyday expenses with tax-free money now. So thanks again, guys. Hope you have a good rest of your day.